One day you realize your hard-earned money is quietly disappearing, not from theft or a bad investment, but from something invisible and relentless: inflation. You check your savings account. It still shows the same number you deposited last year. But when you go to the grocery store, that same amount buys 10 to 15% less food. Rent has jumped again. Fuel costs more. Your morning coffee feels like a luxury. The brutal truth? Idle cash in a regular savings account is losing purchasing power every single month. With global core inflation hovering around 2.8% and U.S. figures potentially pushing toward 3 to 4%, depending on economic pressures, your money is eroding faster than most people realize. Most people will watch their life savings slowly melt away without ever understanding why. They'll work decades, save diligently, and still retire with far less real wealth than they expected. They blame expensive times while doing nothing to fight back. But a small group of smart individuals, regular employees, side hustlers, and beginners, are quietly protecting and even growing their purchasing power right now. They're not financial geniuses or millionaires. They're using simple, proven strategies that turn inflation from an enemy into something they can beat. What are they doing differently? In this video, I'm going to reveal exactly how to protect your money from inflation, even if you're starting with just a few hundred or $1,000. Stick around until the end, because what most banks and experts won't tell you could cost you tens of thousands over the next decade. If you do nothing, the damage compounds. Inflation isn't just higher prices today. It's a silent tax on your future. Global inflation remaining sticky, with U.S. core CPI potentially around 3.2% and risks of upside surprises from tariffs, supply chain issues, or energy shocks. What feels like a manageable 3% erosion this year becomes devastating over 5 to 10 years through the power of compounding. $10,000 saved today could have the real buying power of only $7,000 to $8,000 in a decade if inflation averages 3 to 4%. Most people keep their emergency funds in low-yield accounts earning 0.01 to 1%, far below inflation. They watch peers who invested wisely pull ahead while their own nest egg shrinks in real terms. They tell themselves, "I'll start later," or "I don't have enough to invest." Meanwhile, variable rate debts become more expensive, lifestyle creep eats any raises, and retirement goals drift further away. Stay with me, because I'm about to expose the real reasons most people lose the inflation battle, and the exact beginner-friendly playbook that protects your money and even lets it grow in real terms. We'll cover high-yield savings, inflation-protected bonds like TIPS and I bonds, real assets such as real estate and commodities, stocks with pricing power, gold, and practical daily habits. These strategies work whether you're in the U.S. or anywhere else facing rising costs in this current time. By the end, you'll know precisely which steps fit your situation and how to start protecting your money today before the erosion gets worse. Let's slow down and reveal the truth step by step so you can actually apply it. Protecting your money from inflation starts with understanding two core ideas: preserve purchasing power and seek assets that grow faster than rising prices. First, move your cash out of zero-interest accounts. In high-yield savings accounts, HYSAs, from online banks are offering 3.5 to 4.5% or more on deposits. This isn't beating high inflation entirely, but it's a critical first defense for your emergency fund. Aim for 3 to 6 months of expenses. Every extra percent helps slow the bleed. Next layer: inflation-protected government securities. Treasury inflation-protected securities, TIPS, adjust both principal and interest payments based on the Consumer Price Index, CPI. If inflation rises, your investment grows with it. Series I savings bonds combine a fixed rate with an inflation adjustment, making them excellent for medium-term protection. These are low-risk, government-backed options ideal for beginners. Not all stocks are equal in inflation. Invest in companies with strong pricing power, blue-chip firms in essential sectors like consumer staples, healthcare, and utilities that can raise prices without losing customers. These stocks historically deliver returns well above long-term inflation. Diversified stock portfolios or low-cost index funds have beaten inflation over decades when held patiently. Add real assets. Real estate, including REITs, real estate investment trusts, tends to rise with inflation because property values and rental income increase. Commodities like gold, silver, energy, and agricultural products often perform well during inflationary periods because they have intrinsic value and limited supply. Gold, in particular, acts as a classic store of value when currency purchasing power weakens. Practical habits matter too. Track every expense ruthlessly. Small leaks like unused subscriptions or daily takeout add up fast when prices rise. Negotiate bills, switch to rewards credit cards for cashback, and focus on paying down high-interest variable rate debt quickly. Boost income through side hustles or skill upgrades, so your earnings keep pace with or exceed inflation. The slow reveal builds because these strategies layer together. Start with cash optimization and debt control foundation. Add inflation-linked bonds, safety, then equities and real assets growth. Beginners can begin with just $100 to $500 in a high-yield saving account or fractional shares. Consistency over 90 to 180 days shows results. Your money stops melting and starts working for you. Real people are using apps for automated transfers, robo-advisors for diversified portfolios, and direct treasury purchases for tips and I-bonds. The key is starting small and scaling as you learn. Every month you leave money idle or in underperforming accounts. Inflation quietly steals more of your future. With yearly projections showing potential U.S. inflation rebounding toward 3 to 4% amid policy shifts and global pressures, the erosion accelerates. Picture the average worker. They get a 3% raise but watch grocery, rent, and energy bills rise 5 to 7%. Their savings lose real value. Variable rate loans become more expensive. They doom scroll instead of acting, convinced investing is risky or I'll wait for the perfect time. One emergency, medical bill, car repair, or job disruption forces them into high-interest debt, compounding the damage. Their retirement account, if mostly in cash or low-yield bonds, fails to keep pace. Confidence drops. They stay trapped in a cycle where expenses always seem to outrun income, complaining about the economy while doing nothing to build defenses. Meanwhile, the prepared ones pull ahead. They move cash to high-yield accounts, buy tips or I-bonds, allocate to dividend-paying stocks with pricing power, hold some gold or commodities, and invest in real estate or REITs for rental growth. Their purchasing power holds or grows. The gap widens dramatically over time because of compounding in reverse. Inflation hurts the unprepared exponentially. The longer you delay, the heavier the psychological and financial burden. Lifestyle creep sneaks in, nicer gadgets, more dining out, just as costs rise. Suddenly, even catching up feels impossible. This is the darker reality. Inaction doesn't keep you neutral. It actively moves you backward relative to those who started protecting their money months or years ago. Your window to act affordably is now, before higher rates or volatility make entry points tougher. Here's the twist that shocks most people. You don't need to be rich, a Wall Street expert, or take huge risks to protect your money from inflation. The real secret is accessible and powerful. Combine simple cash optimization and debt control with layered inflation-resistant assets and daily consistent habits. Real examples prove it works. A regular employee moved their emergency fund to a high-yield savings account earning over 4%, bought Series I bonds for part of their savings, and allocated a small monthly amount to a diversified index fund plus some gold exposure. Within a year, their cash was no longer melting, and their overall portfolio began outpacing inflation. Another beginner used REITs for real estate exposure without buying property outright and focused on companies with strong pricing power in healthcare and staples. TIPS and I-bonds provide direct inflation adjustments. Gold and commodities act as hedges during uncertainty. Equities and quality companies deliver long-term growth above inflation. Real estate and REITs benefit from rising rents and values. Even small allocations compound powerfully over time. The shock payoff? Once you start protecting your money properly, inflation stops being a scary monster and becomes something you can navigate, even profit from in real terms. Your first $1,000 to $5,000 protected feels like a victory. Momentum builds. You gain confidence, knowledge, and real purchasing power. The second and third layers become easier because the foundation is solid. Ordinary people are quietly shielding their wealth and positioning for growth using exactly these methods. The hardest part is the decision to start. So here's my direct challenge right now. Pause this video and decide. What is your very first step to protect your money from inflation today? Open a high-yield savings account, research tips or bonds, track your spending for 1 week, or allocate a small amount to gold or a diversified fund. Don't just watch and forget. Your money's erosion stops the moment you take action. See you in the comments in the next video, or see your purchasing power still melting away in 6 months. The choice is yours.